Well, good afternoon, everyone, and welcome to our first Advisor Symposium for 2018. I think I know most of you. My name's Damian, Crowley, Head of Distribution. Thanks for taking the time to join us for lunch today. Now, investing for your clients' money always presents challenges for you, but I think never more so than at this point in time. So not only has market volatility increased sharply, obviously after being low for quite a sustained period, but also geopolitical risks, aka Mr. Trump, have never been higher. So interest rates have also been low for so long, and obviously that's supported growth assets like equities, but they seem to be at an inflection point. I think overarching all of this, which is the theme that you're going to hear today, is that there's a lot of challenges now to sustaining our way of lives, given the increased population and tied in, I suppose, with scarcer resources. And then how do you understand the implications of what those challenges mean, I think, from an investment perspective. So today we're joined by three speakers who are going to address some of those issues and hopefully give you some information that you can use with your clients in your discussions with them. So our three speakers today are Ted Franks, who flew in yesterday from London, from WHEB Asset Management. I think he's over his jet lag. He's the investment manager, WHEB, the investment manager of our Sustainable Impact Fund that we launched last year. Our second speaker is Michael Armitage, the Head of Fund Advisory within the Financial Risk Management Division of Milliman, a global actuarial firm. And I think our third speaker you would all know, which is Rhett Kessler, the CIO and fund manager of our Australian Equities Fund. I won't spend too much time on this slide, but obviously we've gone through the merger with Hunter Hall now. We now have around 3.5 billion under management. Are a listed company, obviously, PCG, Pengana Capital Group, and obviously our funds go across a range of strategies, which I'll come to. All our funds, I think most of you in this room would know this, but they're focused on risk-adjusted returns, and we're very serious about that. So we never talk about returns. We always talk about risk-adjusted returns, whether the outcome of that is lower volatility, usually, and certainly smaller drawdowns, and on strategies that we think will genuinely add value to your clients' portfolios. So we're looking for fund managers and strategies always that are doing something different, and I think you would know that. And in terms of implementing this, we believe we've combined the best of boutique funds management, if I can use that word, with institutional governance and systems. And boutique in the sense that our focus is on returns, not on increased FUM, as demonstrated by our capacity limits on all our funds. You know our Emerging Companies Fund is currently soft closed. Our Australian Equities Fund, we've been managing the capacity for a while now. So we're very serious about that, and the strategies you'll hear today in terms of WHEB, it certainly has capacity limitations, and our Australian Equities Income Fund as well. Secondly, our fund managers are all aligned with your investors and their outcomes. They have significant ownership. They usually own half the funds themselves, and they have significant personal investment, all our managers, in the funds. Thirdly, our investment teams, they've structured their mandates the way they want to run money. That's the whole point of why they want to join Pengana and why they leave some of the bigger shops. They want to be truly active. They want to have the flexibility to back themselves to deliver investment outcomes, and therefore they're very similar in terms of being benchmark unaware, taking meaningful position sizes, so concentrated portfolios, and often the ability to hold reasonable levels of cash. And just finally, in terms of this slide, our focus is unashamedly on advised and retail clients, not institutional clients, which we believe makes our client base and our business more resilient, more diversified, and your clients and yourselves less subject to the risk that a large institutional investor will pull out money, which means we then have to liquidate a part of the portfolio, which then has implications for the remaining investors. So actually quite significant. In terms of our strategies, we probably confused you over the last year. There's been a lot of emails, probably from myself, so apologies for that. We've renamed all the funds now, but effectively what we have is 6 strategies. We have our international all caps, as we call them, so international team of 6 people can run money across small, mid and large cap stocks. And that process is essentially the same across all those strategies in that box. So long-only fund, a fund with an ethical screen, our ethical fund, the fund we're talking about today, which is the managed risk, which is the international fund with a Milliman further risk overlay, our ethical opportunity fund, which is currently closed because it's got significant tax losses, and then our LIC, which is PIA. Effectively run exactly the same. The portfolios are almost identical. There might be slight variations in terms of the ethical fund and the screening, and we use Sustainalytics for that. Then you have the global small cap strategy, which you might know run by Lizard out of Chicago. Obviously, the WHEB fund, our Sustainable Impact Fund, managed by WHEB out of London. The Aussie Equities, I'm classing as one strategy. We have our well-known Australian Equities Fund, and we launched last year an income version of that fund, which Rhett will talk to. And then we have two absolute return or market neutral strategies. I think you might know one based out of Boston, managed by Pengana, and obviously one based in Sydney and Singapore and managed by Antonia. I'll now hand over then, based with that introduction, I'll now hand over to Ted Franks to take you through the world of sustainable impact investing. Thanks.
Thank you, Damian, and thank you everybody for taking the time to hear me. And I think thank you also before I start to Pengana, who reached out to WHEB last year to address what was then the Hunter Hall Deep Green Trust that they wanted a new manager for. I think Damian's outlined some of the reasons why WHEB and Pengana really are a very good match, because we're also a boutique fund manager. We care about our investor returns. We're very much benchmark agnostic. So, starting off. So who is WHEB? Just a couple of words about us. We're an entirely sustainability-focused, London-based boutique. I love these slides from Pengana. This is the whack-a-mole slide. Look at our little heads popping up there out of the slide. 3 partners, myself, George Latham, who was here in October, and Seb Bilo, the head of research. We own the business. We're very ably supported by another team of 5. And there's a couple of points about us which is worth just bearing in mind. The first is we are pioneers in this, and this is positive impact investment. I'll tell you more about that in a moment. The strategy we run now has its origins back in 2005, and this team launched it. By then, at that point, we were very pioneering. In recent years, we've had wonderful validation that larger fund groups have tried to follow us into this space, but we are absolutely perceived as pioneers and are always trying to push out the envelope of sustainability investing. And the second point is related, which is to say, you can only push out the frontiers of sustainability investing, really, we think, from a boutique structure, because if you want to make this product as authentic and as high quality as it can possibly be, that's surprisingly difficult if you're constrained by traditional large fund management houses, and there are a lot of them now trying to, as I say, follow into this space. So, the space itself, let's just think about sustainability investing. Why is there now this enormous imperative around sustainability, and why is it translated into environmental markets, capital markets? The key point really is us, human beings, since 1970, doubling in number on this small planet, and all with the aspirations to live the same very high quality Western lifestyle, which we're all doing now, by the way, in this incredible ballroom. It's fantastic, and the food looks amazing. This is the lifestyle that everybody wants. But the challenge of absorbing all that extra resource demand is taking its real toll. So a couple of numbers for you here. The Grantham Institute and Sheffield University did a study. They reckon around 1/3 of usable arable land has been lost in the same period. The World Wildlife Fund regularly updates its biodiversity study. They think half of it's gone since 1970. So there's a real challenge from mankind's new extended footprint. And that translates into real challenges for the future. So flipping around from 1970 in the past to 2050 is perhaps a sort of finishing line in the future. The big one that you'll all be aware of is the need to halve emissions to stay on the so-called 2-degree pathway to avoiding irreparable damage from climate change. But at the same period, we're going to have to process or absorb twice as much solid waste. We're going to have to increase food production by half again. And even some of the social themes are becoming very intense now. So infectious diseases, previously the lead cost of human life, being replaced by chronic diseases, oncology, cancer, cardiovascular and diabetes, and they have a whole range of their own challenges themselves. And what this has resulted in is a very profound change to the way economies and industries are structured. Carlota Perez, an LSE economist, 2002, she coined this idea of the 6th industrial revolution. And you can see the other revolutions here in this schematic. The thing that's most profound about this revolution is the previous revolutions, going back to the original one, where I'm from, Northern England, late 1700s, bit of steam, bit of wool, bingo, off you go. They've all been about new technology and then growth. Let's just go and increase productivity, increase consumption, make everyone's lives better, no problem at all. For the 6th industrial revolution, the first time we're constrained. We've got to think about constraints, we've got to think about changes to the way we do things. The challenges are much greater, the timescales actually arguably are shorter, there are more lives at risk. So it's quite intense, so there is this imperative, the world needs to change. So from an investment point of view, change, growth, this is where opportunities are. And really, we think it separates the world into kind of 3 buckets of equity. On the right-hand side of this slide, you've got the clear losers over the long term for sustainability. And there are industries which are just not sustainable. Every extra dollar of revenue they earn is creating more of a problem. For most of the economy, companies that we call transitioning, they've got to respond to sustainability challenges. In most cases, it's going to be a cost for them, it's going to be a burden, they're going to have to rotate towards it. But otherwise, what they do is not directly speaking to sustainability, they're effectively neutral. Where we're interested in investing is where you get the maximum impact of this transformation. So impact companies, the service or the product that they make, every extra dollar they earn is providing a solution to a sustainability challenge. 3 examples from our portfolio here. Kingspan, maker of insulation. Insulation reduces energy use in buildings. JB Hunt, if you ask the JB Hunt guys if they're a sustainability firm, they'd be pretty robust in their response, I guess. They're from Arkansas, but they're good guys, and they do intermodal transport, which is taking freight off the road and onto trains. And then Nitto Denko, a Japanese company, makes all kinds of energy-efficient specialty chemicals for use in lots of applications, including smartphones. So these are the solution providers. And I think it's worth just pausing now just to talk about a little bit of what other noise there is in this market around us at the moment. And that's this idea of ESG and lots of brands, environmental, social, and governance factors, and lots of funds which are branded as sustainable. Just to be completely clear, Unilever here, which I'm going to pick out as a sort of classic champion of an ESG fund, and there's no question that the way they conduct their business is genuinely very sustainable. They have fantastic diversity, they have lots of talent management, they've got very good work on their environmental supply chain, they can tell you where all their ingredients come from. At the end of the day, they're combining those ingredients to make ice cream. So for us, that's neutral. You might even argue it's sort of negative. It's not a solution to sustainability challenge. And that's why we're different to many of the sustainable funds you see out there, because there is this impact focus. That's where the most opportunity is. So onto the strategy itself. How do we get our arms around it? The first is we define it into 9 key opportunity pools at the moment, which is our themes. 5 of them are environmental, 4 of them are social. So, sustainability is absolutely a social issue as much as an environmental one. And you can see immediately that cleaner energy is just one of these. So this is not a single thematic climate change fund. You'll see soon there's much more diversity in it than that. And from this universe of companies which qualify as sustainability companies, we can start to learn some interesting things and we can start to underpin this investment strategy of ours. And here's the first thing. I've talked about how there is superior growth from providing a solution to sustainability challenges. Here's some of the proof of that. This is revenue growth numbers, annual revenue growth numbers. There's our universe on the left-hand side, sustainability solutions. The broader overall economy here is defined by MSCI's universe of listed stocks. So that's not a GDP number, it's a revenue number for all the stocks in the world, or whatever portion MSCI. There's an MSCI person here, isn't there? He'll tell me how many stocks that is, many stocks. And then here on the left-hand side, I mentioned these unsustainable industries dropping by significant order for an annual diminution in the size of the revenue of those industries. So this change is happening, and it provides us with this very steady tailwind to invest in. So let me now go through a little bit more of some of the opportunities and some of the stories underlying that 8.5% growth and where the real sort of sustainability action is happening at the moment. Here's the first one, advanced manufacturing. The factory floor is changing incredibly quickly, and it's changing because information technology and the use of semiconductors particularly is making it possible to take what would otherwise be very manual and very, frankly, unchanged for decades processes and make them much, much more efficient. On the left-hand side, machine vision, this is the sort of centerpiece technology for artificial intelligence. Energy savings there, 20 or 30%. In the middle, fiber lasers replacing the legacy CO2 laser technology. That's around a 50% reduction in processing costs. And on the right-hand side, perhaps the sort of most voguish one, additive manufacturing, 3D manufacturing. You're just reducing your bill of materials by half as a result of additive manufacturing. So huge resource efficiency savings there. And because this all translates into ROI for the customers of these companies, we're talking about double-digit growth rates in these industries. In most of them, it's more like 20% at the moment and above. Before even you get to the factory floor, there are huge savings to be made, and a key area for this is in design and in simulation. And the rate of improvement of software, particularly enabled by artificial intelligence, even in the last 5 years, is very, very striking. Most of the advanced products that people use in day-to-day life now will have had some element of this kind of advanced design applied to them. The exact numbers on this slide, and as a sustainability investor, I'm delighted to put a pickup truck on one of my slides, but Harvard took the simulation system and the design systems used by Dassault Systèmes, one of our investee companies, and they redesigned the Transit and the F-150, America's most popular vehicle. And they said, if you had gone from the start with optimized CAD, what could you have saved in terms of CO2? And the answers were 14 tons and 7.5 tons for each vehicle. That's around a quarter to a third of the lifetime emissions of those vehicles. And you can imagine what that means, because that's coming from process automation, it's coming from efficiencies in specific design, it's coming from lightweighting. You can imagine what that means in the savings for manufacturing those stocks. So this is another very comfortable double-digit growth market. Another big growth market for sustainability is in doing something about transport. Transport is a third of global emissions, and I mean, I'm sure most of you in the room are aware of the dramatic changes which are going on in terms of EVs and the potential for autonomous vehicles. Before you even get to that slightly more glamorous level of electrifying and changing the drivetrain, cars are actually being electronified, and what would otherwise be manual or pneumatic or mechanical systems for making a car work have become electronic and consequently much more efficient. The chart is from Roland Berger, who I think consider themselves, and I think they're right, they're probably the #1 automotive consultant. This is the proportion of electric components in the cost of a car. And you can see it was effectively nothing in 1950. Now, according to their numbers, 35% in 2020. I'm not even sure that's not a bit low. Certainly on its way to being half the car in 2030. And the beauty of this is kind of I hesitate to use this in Australia, but like the mining analogy, when there's a gold rush, you invest in picks and shovels, right? So forgive me for that. But still, this is a picks and shovels. The action can be electrification. The interesting investment can be electronification. And beyond just electronification of the drivetrain, there's more going on in transport as well. Safety is one of our themes on the social side. People just don't accept now the levels of risk we used to take. Again, electrification, electronification, the application of IT, revolutionizing what goes into the safety applications of cars. 16% growth from Roland Berger figures on using advanced technologies to improve safety in cars. Another big sustainability growth area. Switching gears a bit now to a different part of the sustainability challenge, and that's the impact of climate change in terms of heat, temperature, and weather. So we've had 15 of the world's 16 hottest years in the last 16. That makes sense. So 15 of the world's hottest years in the last 16. And the pressures that produces on environmental and geographical situations and scarcity is pretty intense. And again, coming to Australia, I don't particularly need to tell you guys about this. But that again produces a whole new industry responding to how to handle much less water and also extreme events which have much more water. And you can see here some examples. Okay, in arid zones, it's relatively straightforward. It's about water treatment and new production of water. But actually, there's also a generation of infrastructure that was put in over 100 years ago, which is just unsuited to coping with this. It's a sustainability challenge. We have to address it. It's producing organic growth rates in the high single digits. Another key area for sustainability, advanced materials. The mantra is reduce, reuse, recycle. You can make huge savings in how much materials you have to use. You can make huge savings in how much we have to throw away by using more advanced materials. So, wind turbine blades used to be aluminium. They're now out of composite glass fiber. You can make them longer. You can make them lighter. You can generate more power for fewer emissions. A technology I particularly love, this thing Dyneema. This is one of our investee companies here. DSM makes Dyneema. It's stronger than steel, but it's light enough to float on water. It's an entirely self-contained recycling loop that DSM themselves handle. It holds ships, cruise liners into dock. It holds up bridges, suspension bridges. It's a hugely powerful technology. It's coming from advanced materials. And some advanced materials with big sustainability drivers behind them aren't even that advanced, right? So cardboard, I mean, particularly now as e-commerce becomes the ubiquitous way that people buy things. My house, thanks to my wife, my house has simply no day where there isn't an Amazon box coming through the door. And cardboard suits that very well. It's strong, it's light, it's fully recycled, it's fully recyclable. And of course, we're all aware now that plastic usage has become ridiculous. The oceans are absolutely full of it. No one has ever seen plastic degrade. It takes 500 years. So no one even knows if it will yet, right? So huge challenge, and there are solutions to it. Another big thing to think about in terms of sustainability is what is science's response? And you've seen already from the advanced materials slide that science is a big part of this. We're a clever bunch, humans. We're cleverer than we ever were. We've now made machines which are even cleverer than us. Science is a big deal, and it has providing all kinds of solutions to the sustainability challenges. The one that's most interesting, really from an investment and rate of change point of view, is life sciences. So biosimilars, genomic sequencing, improvements in robotics, in interventional medicine. The rate of research in life sciences is twice the rate of other scientific endeavours over the last 30 years and will continue to be so. This is a huge, huge change. The last of the transformations I'm going to talk about is every bit as profound and absolutely fascinating, and that is what to do about healthcare and how much it costs. The truth is, healthcare has become unsustainably expensive, and that doesn't matter really where you are in the world, it applies everywhere. Part of it is that humans are older and more frail and living longer. Part of it also is that the markets don't really work. There's a natural asymmetry if you're sick. You're trying to buy something and someone's trying to sell it to you. They know more about it than you do, and they're not sick. So there's been all kinds of pricing power in the health market, which has been totally unsustainable. One of our investee companies, quite a specific example, Centene, is actually a US insurer. Insurers don't sound like they're naturally providing a sustainability challenge, but these guys run the government schemes for coping with the poorest and unfortunately often the sickest populations in the US. That's called Medicaid. It's the Medicaid program. And by outsourcing from the government to Centene, putting the private sector incentives in there, you can save these huge amounts of costs. These are academic studies showing you an estimate of how much the cost saving could be. I mean, clearly, I'm going to pitch it in the middle at 10% there, but it's obviously substantial. And in terms of dollars, that's $7.1 billion per year in the US. That can be spent on treating other sick individuals. So it's a response to the sustainability challenges. So really, hopefully you'll seen that sustainability is kind of everywhere. It's all around us. Everything is changing very dramatically, whether it's, in this instance, high-efficiency facades or low-impact materials in clothing. There are lots and lots of different changes going on and lots of different ways to invest in this. But how do you do that? And the sector, the sustainability sector, my partners and I have been in it for, between us, 20 years, has had a few mishaps, missteps. 2007 sticks in the mind, particularly the big cleaner energy sort of boom and then bust. You can't just throw money at these very compelling themes. You will come unstuck very quickly. How do we address it? Where does our performance come from? There's three aspects. We've talked about the growth, so I won't highlight that to you anymore, but obviously we are investors. You've got to bear valuation in mind. We're not able to just go out and say, as perhaps the tech sector has done recently, this is going to be a dominant winner and we're going to take it at any price. So you have to have some sense of valuation underpinning, and obviously we do a lot of work there. You're only an investor if you're seeing something that others aren't. But really the key to how we invest, and again there's shades here of other Pengana strategies, which is why we're partly a good fit, is we have this very strong emphasis on quality. So if we can see a sustainability driver that we want to invest in, and we want to give that to our investors, we want to sort of channel that equity to the investors' benefit, the trick is to make sure you reduce the mishap in between. You get the highest quality companies you can. We ourselves, we try and take ourselves out of the picture. We have long hold periods, over 6 years. We have, my own animal instincts are, as far as possible, ring-fenced from causing a problem for you. And the companies themselves, we have this strong quality focus. A couple of points about that. We look at various financial metrics. For my sins, I'm an accountant as well as a CFA. Those years of exams, I guess they paid off. We'll talk about them another time. But our sort of key metric that we like the most is unlevered free cash flow, return on invested capital. That's really a very general affirmation of the quality of a business model. How much money are you making now from the assets that you had and how effectively and how repeatably can you do that. And you can see here how we differentiate ourselves from both our universe and from the benchmark. We're a higher return quality strategy. And the other very important thing to talk about in quality here are these ESG factors, which I talked about before. And I hope I'm being clear. We're not led by ESG. We're not the same as many of these strategies that are branded sustainable. We're about impact first and foremost. But if you want to understand whether a company is investable for 5 or 6 years, you absolutely should be looking at the management's approach to environmental, social, and governance factors, because these are long-term factors. These are the challenges coming down the track to the business in the future. If management does not have an answer to these, if there are all kinds of mishaps and accidents happening the whole time, ask yourself, can I really get on board with this for as long as I need to? So that's nearly it from me. The last thing just to talk about, for many investors, will be the most important. I'd love to take more questions on this later on if you want. And that is, as you've seen, our investment strategy has always been about alpha, about the opportunity from sustainability, which is very profound. But by investing in the companies that provide solutions to sustainability challenges, those who feel a connection with their investment, and I'm one of them, can be pretty clear about being able to identify or being able to make a strong claim to having a positive impact. We're very keen on this. We were the first fund to report on our impact. We were the first listed equity fund to be in the Global Impact Investing Network. We try and make it as clear and transparent for everybody exactly what the positive impacts associated with investing in our fund are. These are the numbers from 2016. They're just being updated now. Last year was just environmental numbers. We're going to do social numbers this year, including lives saved from various of the therapies we invest in. And there's even a calculator, a live version of this that you can use, which I think Damian might tell you about later on, so you can put your own clients' money into it and sort of have some idea of where the positive impact is. So with that, I'm looking forward to having some questions in these frankly magnificent thrones behind me, and I will pass on to Michael Armitage. Thanks.
Good afternoon. My name is Mike Armitage. I work with Milliman here in Sydney. Some of you may have met me before at some other setting. Very happy to be part of the day here with Pengana. Thank you, Ted. I think that was very interesting. And I think the most interesting thing of that is how this industry can find some solutions. Our business is definitely a solutions business. Milliman is a retirement specialist. It might sound a little bit boring to most people out there. But for the actuaries who I work with, this is all they live and breathe, for better or worse. So what we want to talk about today is really managed risk and how many retirees are facing significant challenges. And it doesn't only pertain to retirees, it's really to anybody who's interested in risk-adjusted returns. So in terms of equity investing, it's the best, historically it's been the best way to increase your assets. But obviously there's, the other side of that is the volatility that may come along with growth assets. There's a need, particularly for people who are very sensitive to capital loss, of protecting the downside, but maintaining growth. And that has become even more pronounced and significant as the world's gone to, zero real rates of return. So again, there's challenges around equity investing. And besides just the growth and volatility of returns, there's also some issues in terms of diversification as being your only risk management tool. Historically, during stress periods, diversification doesn't really help that much. And we'll point that out a little bit later in the slides. And for retirees, the dynamics are completely different. So when you stop working and you're living off of assets, to be hit with capital loss creates a whole bunch of issues, besides the fact that it may reduce how long your assets will last in retirement. But probably more importantly is the top right-hand box, it's human behavior. So from our point of view, if you're not addressing those two issues for people that are coming close to retirement that you may be managing money for, you're really doing them a disservice. There's the dynamics of retirement and the exhausting of assets is critical to manage. If you're not doing that, we would argue that you're really not a retirement solution. So the human behavior side of that is humans, just full stop, don't like to lose money. There's a loss aversion. There's been studies in the States around this, the AARP, which is the, I guess, the retirement industry body. They did a study, and the average human has this 1 to 2 kind of loss aversion, meaning I need 2 times the upside in order to compensate for the feeling that I have from, you know, one times the downside. That actually gets magnified as you get older. So for retirees, they say that that ratio actually moves to 5 to 1. So it makes total logical sense, and some of you in this room probably experienced this during the GFC, that when the markets became very volatile and people lost money or they saw their monthly statement, they were calling you up and saying, get me to cash. Typically at the worst possible time in the marketplace. So if you're not managing those inside of an investment product or what you're doing for your clients, most likely they're going to have a bad experience. So that brings us a little bit today of, I guess, why I was invited to come along here. We have a product in the marketplace now, working with the international equity team at Pengana. And besides their flagship offering, there's also a separate offering which combines their international fund and Milliman, an overlay that we run for a lot of pension funds, insurance companies, and asset managers around the world. We'll talk a little bit about that today. So why Milliman? Milliman is an actuarial company. It's been around since the 1940s in the States. The group that I work with inside of Milliman is financial risk management. And our business really developed in the mid-1990s, late 1990s, as insurance companies were offering guaranteed products. So think of deferred annuities in the US. As a good actuary, they were measuring those risks. And eventually we developed and implemented consulting practice to hedge those risks for insurance companies. Jump forward to the GFC, post-GFC actually. A lot of asset management companies of the insurance companies in the US said, why can't we just take what Milliman does and start to put those into funds, mutual funds, pension funds. And so since the GFC, our business has almost doubled to where we're managing about $150 billion worldwide for client exposures, managing risk. And I think that kind of also that growth has come about in terms of just the demographic shift of what's going on. Certainly in the US, this category, which we've termed managed risk, is probably the fastest growing subsector of the financial industry, being driven by the demographics of more and more people coming into retirement. So why a managed risk strategy? I think it's good to kind of highlight here how Milliman looks at risk management. So that bottom block, that would be diversification. So that's, you know, kind of the bog standard thing out there, the free lunch, if you will, in terms of you know, classic portfolio management. What we do, our business really looks at the top 3 of segments of that pyramid. The light blue area is the strategy, what we'll talk about a little bit here today, of what we do for the Pengana International Fund, what we call risk control or managed risk. When you go up the pyramid, the top of the pyramid would be things like guarantees, annuities. On the right there, the arrow, if you can see it, is just the cost, the expected cost of each one of those risk management strategies. So the lowest one obviously is diversification. And as you go up the pyramid, things can become more expensive. What's really interesting is post-GFC, as the world's gone to 0 interest rates and the charging of capital for insurance companies has gotten higher, the insurance companies who offer annuities or deferred annuities, they actually demand now that the funds underneath those annuities are actually managed risk, because it lowers the cost of capital and it lowers the cost for them providing guarantees. So we mentioned earlier diversification. It's not, you know, it's not the end-all be-all of, or the only way you should be managing risk, particularly for people who can't weather capital loss. And this just highlights during the GFC period, and it's similar to many systemic events, that asset classes tend to move together during the systemic event period. So there's two different types of risk to manage. There's diversifiable risk, and then there's systemic risk. Unless you're explicitly managing systemic risk in a portfolio, you're susceptible to these significant drawdowns. And so let's just highlight how that sensitivity for the retiree is and sequencing risk to kind of just spell out. I'm sure you guys are become very familiar with these terms over the last years. But it just highlights the dynamics are completely different for a retiree than somebody who's an accumulator. So what we're showing here is the impact of a loss on a portfolio depending where a person is in their age. So if you have the loss, the same magnitude of a loss when you're 30 years old, it has an impact, but it doesn't have the same kind of magnitude of impact of having a loss just at the peak of this, and we'll assume that somebody retires at 65 years old. The loss in this is something very akin to what a balanced portfolio may have faced during the GFC. And in this instance, what it did, it knocked 13 years off the longevity of that asset portfolio lasting through retirement. So again, the significance is there is a clear distinction between people who are accumulators and who are coming close or in retirement. To circle back onto that behavioral bias, this is a back-tested analysis just to kind of show out, what those magnitudes of the impact could be if somebody did, come out of I think this was a 70-30 or an 80-20 fund during the GFC, went to cash. And you can see, if they stayed in, which most people would in this room tell their investors to try to stay in, over time they may make up the loss. But human beings don't act that way. They don't act rationally or act logically, especially if they've seen their portfolio just lose 30%. What they'll tend to do is they'll go to cash and they'll wait, and they'll probably come in at the worst time as well, come back in after the market's gone up. But these things really do matter, and unless you're taking them into account into your products, you're not really addressing some of the issues around retirement. So managed risk for us, what are the objectives of what we're trying to do? We're trying to reduce losses, address sequencing risk for those people that are very sensitive. That gives us a smoother level of returns through retirement or through life, which will probably have an effect in terms of human behavior. And if you can address those things, you guys in this room spend a lot of time making investment plans for your clients. If you can keep them in plan, they're most likely going to meet those goals that you've designed for them. So specifically around the product that we're working with, we've got three separate areas of risk management here. So in the flagship offering, the gray box and the blue box would be run by the investment manager. So that's things like stock selection, portfolio construction, a full active investment manager. And the Milliman overlay is simply one other sleeve in that risk management arsenal. So again, along the theme of, I guess, the Pengana philosophy, the underlying fund manager is certainly a qualitative manager. Here are all the attributes that are looking for. This is logical, common sense, proven ways to actually manage money. What I should kind of highlight here is the underlying manager's ability to have a lower risk portfolio actually interacts with our work. So our risk management strategy is always on watching what the portfolio risk actually is, and it's managing it in real time. So if the underlying manager is doing a lot of things in their asset allocation, their stock selection, their portfolio construction, that's lowering risk less than the market risk, we're taking that into account, and it actually makes our job a bit cheaper in terms of addressing the explicit risk management bit. So our overlay, what we're trying to do is dynamically manage the net exposure to market risk. When markets are normal, benign, upward moving, we're not going to be doing too much. So the underlying portfolio will be more fully invested, and you'll be able to participate in most of the equity growth. As the market becomes more turbulent, uncertain, higher volatility, downward moving, we start to come back on taking out market risk exposure. The way we do it is we use equity index futures. It's the simplest futures contracts out there, the most liquid, the cheapest instrument to hedge. We don't interfere with the stock selection of the underlying manager. That portfolio stays 100% invested, or wherever the investment is of the underlying fund. We're simply overlaying a short futures position to net out some of the market risk. And that amount that we're shorting is dependent upon how volatile the market is or how much loss the underlying market is experiencing. So the benefit of the strategy is we have this smoothing effect. We take out the major falls in the marketplace. You're still going to participate in some of the losses of the market. We're not an absolute return hedge fund type of strategy. This is risk management. We're trying to smooth equity returns, truncate the left tail or the significant losses experienced by the market. But we do it in a predictable way. Again, we're not discretionary managers. This is an actuarial or a mathematical exercise. We do this for insurance companies. If you think about our DNA, where we come from, insurance companies are capital regulated. In order to get capital relief, the regulator needs to understand what it is that they're doing in their risk management strategy. So it's a rules-based approach. It's very predictable in terms of we're going to be there saying what we're going to be doing when the market has these kind of fits and bouts. And probably the most important thing in terms of Milliman, we've been doing this since the mid to late 90s for our clients, and we've been tested through two significant market falls, the tech wreck in the US and the GFC, giving us a bit more confidence in what we're doing is achievable. So again, the objectives of the strategy is to capture most of the equity market growth, be able to stabilize portfolio level returns, and to reduce major significant losses. And the way that that's structured here down at the bottom of this slide is you have the underlying fund, and then you have the managed risk overlay. And that ratio is for every $100 that comes in for the managed risk fund, $95 goes and buys units in the existing flagship fund, and $5 will go sit in a futures account that has futures and cash. And so daily, it's the combination of the value of those two accounts which gives you your daily NAV of this managed risk fund. I like this slide, and it's a back test of MSCI World. But the yellow kind of peaks a mountain range in the background just shows you the amount of exposure, the net exposure, so the combined long and the effect of having the overlay in place. And you can see during those periods of the tech wreck, which I mentioned, and the GFC, our net exposure can get down very, very low to sidestep the most volatile and dangerous points in the marketplace. What you see here as well, and maybe it doesn't depict it as well here, but if you sidestep those losses, you don't need the full market returns in order to stay equal or ahead of the underlying marketplace. And that really is just putting back the power of compounding returns into a portfolio. That really is all that we're doing here. If I don't lose 30 or 50% in a GFC period, I lose 15 or 20. I don't need the full market returns over the full life cycle in order to stay ahead of the marketplace. But more importantly, what I've done is I've lowered the anxiety of the investor. I've sought to seek to address that human behavior, that poor human behavior element in investing. So we put this up to kind of just show different market environments and how equity investing and managed risk investing would be expected to perform. So obviously in a steady rising market, high vol rising markets, even equity is, 100% equity is the best place to be. And you can see other periods where equity obviously gets challenged, right? So sustained market drawdowns, for instance. The second column is equities and investor behavior, kind of the expectations of how people would react. And you can see in periods where there's a sustained market drawdown, we give that a yellow. But over the full market life cycle, we expect that poor behavior. I think it's there's a group out of the U.S. that does all these studies. There's index returns and then there's investor returns. Investors never perform as well as an index, and that's just because of poor human behavior, calling up their financial advisor and exiting the market at the worst possible time. With equities managed risk, we won't have the full expected return of the marketplace, but we'll be able to provide benefits during some of the other challenging periods. And certainly if you come over to the right in terms of looking at overall market growth or overall asset growth in a portfolio, fixed interest and annuities don't really provide any of that. So there's a place for everything, but we're seeing a lot more people coming to us now as an alternative to fixed interest, or maybe I have to take a bit more risk for certain clients because of where interest rates are. Well, I need to marry that up specifically with a explicit risk management, and then I feel a bit more comfortable putting them into a bit more growth. I think this slide's interesting. It kind of just solidifies what our objective is in terms of the managed risk strategies. We partnered, I think 2 years ago now, with S&P indices in the States, where there's a whole, I don't know, I think there's 40 different ones now in terms of managed risk indices. And so this is S&P's data in terms of backtesting. I think it goes back to either 2000 or maybe a bit further back. But what it's showing is, so the high growth, 100% equity portfolio, all the way down to a 50-50 portfolio, and that's without managed risk. And then in the green is with a risk management overlay on those portfolios. And you can see the objective is we're trying to reduce the maximum drawdown in the portfolio and increase the risk-adjusted returns. So this isn't our back test. This is S&P indices running this back test. If you have Bloomberg, they run these on a daily basis. You can log into those. But again, that is what we're trying to achieve with these portfolios. Really protecting capital and improving risk-adjusted return. I'll finish on this slide because I always like, I don't know if some people in the room may be investors in some of the managed risk categories of products that are out there. Some of the feedback you get sometimes is, why is it behind the index? Well, it's risk management. There should be an expected cost on a short-term time period, 1 year or 6 months. You should be expecting a drag for risk management on the portfolio. And you can see there, maybe I'll use this. In these years here, obviously managed risk is underperforming a unprotected portfolio. But you can see here over a full life cycle, you can have, if you've got significant loss years, you could outperform the unprotected portfolio. Again, what that simply is a compounding rate of return. I'm not losing as much money in a downturn. This is a back test, but I think it's important to notice or get people's expectations right around managed risk products. You're not going to outperform an equity market in a rising market. It's just not. That's not risk management. There's other strategies out there, hedge funds that'll be trading and trying to beat the market. In this strategy, we're not. We're risk managers. What we're trying to do is certainly beyond providing our strategy, buffering these types of events. So with that, I'll hand over to Rhett Kessler.
I understand I have about 20 minutes to go through a couple of things. I appreciate the opportunity. I know I haven't been out here for a while, and it's good to be in front of all of you. I recognize quite a few of you, so thank you very much for your ongoing support. Now, I'm going to do two very unusual things today, which most of you look at me and think he's crazy, but hopefully I'll pull it off. The first one is I bought a new suit. It's the first one in 10 years, so hopefully that looks pretty good. And the second one is I'm actually going to do a couple of macro slides. I've never done this before, so we typically don't do it. But essentially, I think it's necessary. We've been running the business now for almost 10 years. In June, we come to our 10-year anniversary. And the volatility, frankly, was very, very high at the start of that journey. I think many of you started with us in 2008. We started 3 months before Lehman's went bust, so I can't time markets. And secondly, just lately, you've had quite a few months of very high volatility. And a lot of people have been asking us, so what's going on? It would be very glib of me to say that it's simply because ETFs and managed funds have just got so big that the guys actually making the prices have shrunk, and therefore you're getting a lot more volatility. And I think that's a big part of it. But every now and then you have to look back and say, well, how are the fundamentals, the actual underlying fundamentals for wealth creation and capital preservation actually going? And then secondly, are we still in place to take advantage of that? So if this works, there are two themes I want to address today. The first one is, are the fundamentals as Australian investors still in place for us to make money? Or, you always got to wonder when you see this kind of volatility, are we teetering at the end of a precipice? And the road runner that keeps his legs spinning before he drops down. And that's not the case, as I think I'll show. And then secondly, is the Pengana Australian equities team still in place? Which I'm very confident of. So first of all, and just bear with me, there are a few macro slides here, which I'm not used to doing, so I'll just go through them very quickly. But essentially, productivity times population growth is equal to your GDP or your wealth. And that's a very simple equation, and that seems to be holding up particularly well in Australia. We've had very, very strong population growth for some time. And so the zero axis is at the bottom, very positive. Most Western countries are closer to 0 or 0.5%. Secondly, unemployment's actually quite high. And importantly, the participation rate's quite high. So I get a lot of questions about when is the residential property market going to absolutely collapse. And I've thought it's overvalued for the last 10 years, so what do I know about property? But at the end of the day, what we think, as long as employment stays at these levels, things are fine. Then, what's the outlook for employment? Well, NAB Business Confidence Survey continues to be quite strong, and all the companies we speak to seem to be doing okay. Thirdly, the ANZ job ads, which is basically SEEK, look quite strong. And then my all-time favorite, as you know, I talk about this one a lot. This is the Rhett Kessler unofficial index of how the economy is going, is poker machine revenue growth year to year. And as you can see, this has picked up. So we were worried a little while ago when it sort of trended down. These numbers, I should say, are only for South Australia, Queensland and Victoria. They don't include New South Wales because there's a bit of a fight going on about releasing those numbers. We've done the survey, they're fine. They're even stronger than this. I also have another unofficial index, which is what I call the Rhett Kessler Sandpaper Index. I have a friend who sells 20% of the sandpaper on the East Coast, and he can't keep up with demand. He's been quite consistent with the economic cycle. So that is the extent of my macro knowledge. But what I guess I'm trying to say is that in spite of the media's best efforts, things are actually okay. Our team has just returned from Western Australia. Looks like the cycle's turned, but we don't really do mining. We're looking at picks and shovels, as Ted mentioned. And I guess I'm not trying to tell you that everything's okay and everything's fine, because remember that the stock market acts very differently to the underlying fundamentals. And at times it gets out of sync, or most times it's out of sync. So my best guess of what's happened is that the stock market got out of sync by going way above fundamentals, and it's coming back to fundamentals. But the underlying fundamentals is what I'm trying to address here. And our job is to pick out those that are okay around the economy. So the things that worry me, this is quite an interesting chart. I talk about my magic bullet. If I could take one magic bullet, it would be to take all my money out of the stock market and somehow hide it under my mattress, so all our funds, wait for the Reserve Bank to put interest rates back up to 20% like they were in the early 90s, wait for the absolute carnage to subside, and then put all my money back into 10 or 15 long duration stocks and go to the beach for another 10 years as they brought interest rates back down to this level. Right? So, as the cost of money goes down, the value of long duration assets go up, and vice versa. And I think we've now got the headwinds of potentially interest rates going up. So that worries me a bit. And if you look at our portfolio, you'll see we've got a lot of companies that actually benefit from interest rates going up in our portfolio. The other thing that's really interesting, and I know some of you have heard me talk about this before, and that's the bifurcation between different income groups. So if you've had assets, so shares, businesses, property, over the last 10 years, you're feeling like a zillionaire. I'm sure a lot of your clients are in that situation. They feel absolutely wealthy because everything's gone up. But if you're white collar, blue collar, and you've got a few kids and you've been paying school fees and medical bills and tolls and electricity bills, you'll see the blue line, which is called the essential spendings or the non-discretionary, has actually been still quite high in terms of inflation, whereas everything else has come down. So you really have a situation of the haves and have-nots. And that's where this popularism of rebelling against governments and changing of governments, I think, is coming from. There's a real underswell of dissatisfaction with economic lot. And so if you're in the business like we are, trying to find toilet paper and toothpaste type businesses, you've got to be cognizant of all those things. Does everyone still fully employed? Will they still buy toilet paper and toothpaste every day? But what are the pressures that they're under? And that's how we think about businesses. So if I now go on to what we actually do all day, it's business as usual for us. It'd be a lot more fun if stock markets were going up and we were riding, participating, but it's tough. And so we're very, very focused on both capital preservation and giving at least a decent return to our clients for the risk we take on. Our fundamental beliefs have not changed. The slide, well, the background's changed quite a bit because the Pengana advertising guys, but the wording hasn't changed since we started. And then the guacamole, what do you call it, the guacamole slide? I quite like that. Our team has been consistent now for a while. Grumpy and cranky, the first two, are still consistent. We still think we can run the business by ourselves, but we realize that if we hire additional smart guys like Mark and Chris, we can do even better. And so there's a lot of grey hair there. Yes, the slides are in decreasing hair order, but we haven't changed. And the main reason why I think continuity is so important is that you need two things. And my principal requirement as principal of the business is to keep myself and my team psychologically sound. My dad always used to say, you make really good positions from a position of strength, and you make really dumb decisions from positions of weakness. So our job is to remain psychologically sound. And this is one of our biggest tools. So what this attempts to plot is our level of cash in the portfolio, is the black bars, against the equity markets. Now, we don't try to predict the equity markets, but when things get a bit crazy, we generally find ourselves in a position where we've got at least 20% in cash. And I think you can see we've been fairly consistent in that. And yes, we've currently got 21% in cash at the moment. Not because we think the fundamentals are terrible, but we think the volatility is making things quite uncertain. And I'm happy to take questions later about what we think are the other factors causing that volatility. I like to put up this slide because I think our biggest job is not only, if I go back one, is not only when things look really, or we're expecting things to be really terrible, or we can't find things to buy. It's really easy to sit in lots in cash and go, oh, we're conservative, we're always prudent. The really, really tough thing is having the courage to, what we call, reach across the abyss and actually buy things when you're feeling terrible. So I remember spending about $70 to $80 million on the 2 days following Brexit and wanting to vomit and having to walk around the desk 3 or 4 times and sitting down and saying, I just don't have any more strength at the end of the 3rd day to apply any more money to catching falling knives. But at the end of the day, having that courage is absolutely the mirror image of having the discipline not to jump in. And I'm sure someone is thinking, well, where the hell are we on this slide? It's hard to say. And that's why markets are difficult. I think there are 3 things going on. I think generally the industrial economy is actually okay. I think tech's overpriced and we're at some of those places. And then you can build a whole lot of things. But that's always the difficulty of knowing exactly where you are in that slide. And so on a 10-year track record, I think we've done what we set out to do, and that is we're in blue, the markets are in red. And I apologize, the most important line on the slide isn't there, and that's what the risk-free rate plus 6% did. And that's actually between the red dotted line, which is the stock market on average, and our blue line. So we've comfortably done it we've done about 9.5. So we should have done about 9.5, and we've done about 11% per annum on average. And the way we've done that, I'm a chartered accountant and a CFA as well, so I'm in good company here. So we just have a 3-step process where we think. So idea generation, analysis, so is it a good business, and then actually constructing the portfolio. That's what we do. So idea generation, we're still doing the same things. I must say that since we passed $1 billion of FUM, idea generation has got a lot easier in that we haven't had to go out and get everything. Things have started flowing inwards to us. It's almost like one of those space-time things that you see where the bigger the mass, it creates that weight in a trampoline and things start sliding into it. So it's amazing how many companies are coming to see us now. And the real trick is to try and get rid of the ones you don't want to see. So that's been quite good for us. We're still doing exactly the same thing we do. We're asking, can we understand the business? Can we safely predict the business? And then does it have power? And then most importantly, at the end, we always say, so after we've checked that management competent, we ask, can we buy it at the right price? And in response to, and this is a plug for the Aussie Equities Income Fund, which is a tiny fund which is busy proving its straps. It's run by Chris and Mark. A lot of requests have come in. It's great that you guys have generated good returns, but it's always a combination of income and growth. Is it possible to do something that's more income? And so we carry on regardless doing what we do. I'm agnostic as whether I produce income or growth, but in response to requests and because as a result of the Hunter Hall merger, a ready prepared fund fell in our lap, which we converted into the Aussie Equities Income Fund, was set up, and that is focused on everything that we focus on, except if it doesn't have a dividend, we don't buy it for the income fund. So it's really just a subset of what we do. And as part of the marketing, we chose not to reset the performance fee from what we inherited. So it's probably got a year or so of no performance fees because we have to pass the high water mark to catch up from when we took it over. I'm conscious of the time. I don't want to gobble it all up. I've got 1 or 2 more slides. I always like to put up the portfolio to show you that we're pretty index agnostic. We're quite concentrated. 45% of our portfolio is in the top 10. Very, very different to the cumulative weight as per the index. And I promise you, I never do that part of the slide. Somebody else does because we don't care what part of the index they are. So it's always interesting for me to see that it's 20%. Very, very defensive portfolio. We even think that some of the financial stocks are very defensive. No commodities, and about 9% non-Aussie dollar earning streams, which are things like CSL and ResMed. I thought I'd put up a slide, given that I was talking together with Ted. So this is Bingo. For those of you who don't know what Bingo is, I'm sure you see their trucks around. Bingo is a company that floated a year and a half ago now. It's a waste collection and recycling business. So I just thought I'd use this as an example of how we look at companies. So first of all, we say, what are we buying? Well, it's a vertically integrated waste business. They go out and collect stuff, and then they recycle it and get rid of it. So they recycle it or get rid of it. What we like about the business is the fact that there's lots of waste to recycle. It's kind of like toilet paper and toothpaste. But secondly, these guys seem to have, and we've checked and we agree that they do have a competitive advantage in that if you collect a ton of waste and you dump it, you have to pay landfill fees. But if you collect a ton and you recycle 80% of it, and you actually generate revenue out of that recycling, you still charge the guys the full amount as though you were going to dump it in landfill, but you only landfill 20%. And that's essentially, if I just boil it down, that's what that business is about. They've got scale, they've got technology, and they're taking a model that's proven and taking it to Victoria. So then we say, is it a good business? Well, they've got scale, and they've proven they can do it, and they're an industry structure where if they do close down the Queensland dumping regime, that's quite positive for this business as well. Thirdly, is management competent? Look, you should always be nervous when a big family sells down a big stake, and we stood back from the IPO. Stock fell quite a bit as people sort of started measuring up whether taking, shares from a big family or selling out was the right thing. We bought it at a much lower. Fortunately, we managed to buy it much lower after it had proven itself, and management is always under-promised and over-delivered. And I think we bought it at a very, very good price and still had quite a nice after-tax cash earnings yield. So in conclusion, I think I'll just finish up on my favourite slide. It could always be better if there wasn't a dip at the end. I admit that we haven't covered ourselves in glory with one stock. That's hurt us a little bit, but in spite of that, we're still above our targets. So I think I've got to hand over to question time now.